Today we're gonna talking about credit policy and collection. So suppose you make a credit sale, and sometimes for enhance your collection, you may offer the discount, such as 2% discount. Given that the customer would pay you within 10 days. However, whether this credit policy would help you better off than without the policy, you should calculate and make the difference. Then you can have a clear concept in your mind. First, we think about what positive effect would be if you offer the 2% discount when the customer pay within 10 days. First of all, your sales might increase because some customer might previously cannot make the purchase on time, then will take the policy and purchase it. The other point would be reduce of the expense relating to administration fee to collect the accounts receivables. So this part fee might decrease. And what gonna decrease in addition, you may think of, is bad debt. Bad debt is a portion of uncollectible. So when you're doing the business, you will see probably some portion of credit sale cannot receive forever. So this is bad debt, maybe 4% or maybe 5%. So you're gonna got to know from the historical data. Let's look at how to calculate the profit. Then first of all, we have the profit. Profit relevant to the sales revenue management is the sales revenue minus variable cost, which is the cost you produce the product, every cost based on the units of the products, and minus expense. This is the expense only relating to collect the accounts receivable. So this formula, it seems quite easy, and we should advance this formula, such as we assuming how much profit we have now. So you got the profit, such as your sales might increase, so you may have an increase rate. The G represents the growth rate. And what you're gonna have in addition, which is bad debts. This part of the revenue you cannot receive forever. And you minus your still sales multiplied by the growth rate, then multiplied by VCR rate. VCR rate actually is the variable cost relative to the price. So this is the VCR. It's the rate you're gonna be able to know from your historical data. And still minus the sales with the increase rate and multiplied by the expense rate. This is also a rate. It's the administration expense relative to the price. So this is also rate. So you apply this rate to the expense. Then what we should do next? Actually, we should discount them to the present value. So you discount this part by 1 plus the discount rate. Discount rate, this is your opportunity cost. This I represents your opportunity cost. It may be the dividend rate, or maybe the best possible investment return. And here we should have the collection period. So collection period is such as the average duration you get all the receivable come back. Suppose it's 35 days divided by 365 per year. So you discount your sales revenue, but you don't discount your variable cost because this cost had already happened in the past. And you also discount your expense, administrative expense. It's the same thing. Now you got the profit. This profit is called the net present value. So you discount every value to one point of the time. So you can compare them with the consistency. Then next, we shall extend it to assume that what if we offer the credit discount? So would that be different? Yes, of course. So the net present value would be there would be two separate portions of that. First is the percentage of customer who take the discount. So this P represents percentage, such as 50% or 40%, assume take the discount. So this multiplied by the sales with the growth rate, with the bad debts rate, and with the discount rate. Because your discount gives them 2% favor, this 2% is gone. And also you have another portion of sales income, which is the percentage of customer who didn't take the discount. This part would be same as this part. So we just copy it down. Say sales with increase with reduction of bad debts. Then we have this part. The next we still minus sales with growth rate multiplied by your variable cost. You don't count on the fixed costs such as the rental of the property or the warehouse fee. You just assume this fee would not be relevant in the consideration. And you still minus the administration fee relative to the collection. So this part is also same thing. So this part same thing. Just only the sales revenue become two separate parts. The portion take discount, the portion don't take discount. Then we still will still have to discount them. For this part, it's 1 plus discount rate. It's not 35 days, it's 10 days because they had to pay within 10 days. And this part would be same as this is a cost that happened in the past, so you don't discount them. And the last part would just also the same thing. So you can take. Now you got your new net present value with the discount policy. So you can compare those two values to see the incremental part, whether it's increased or decreased. Then you would have clear in mind whether this is worth it. The growth rate you can know from the historical pattern. The bad debt rate you also can know from the data, comparing with current bad debt with previous debt. It may be same thing, may not be the same thing. The discount, usually 2%, would not be too large. And you have the 10 days, so you're gonna know this is 10 days. How do you get this one? 35 days? This average collection date. How do you get the average collection date? So you need to have something about accounting data. First is about this one, had accounts receivable. This information you're gonna find from the balance sheet. The acronym you can write as this, accounts receivable. And also you have the sales revenue. This you got from income statement. Then you use your accounts receivable divided by the sales revenue. But this is not sales of the whole year. You should divide by number of days of the year. So you got daily sales. The accounts receivable divided by the daily sales, you got the average collection period. So you got the 35 days here. Then you have the clear mind about all of this.